All right, welcome back, and we have another video for you. Today's presentation will be the first dividend book in the three-part series. Been talking about this for, a while. So we already did Peter Lynch. That's the first book. Now we're going to do 3 dividend books, finish off with a book about financial statements. Other than that, I don't know. I don't have any plans for any other book reviews. So here it is. This is the book. So this is proof that I bought the damn thing. So I don't hate me, buddy. I'm not stealing I'm not stealing your royalties, whatever. So this is the book. You've heard of this guy. He's a certified he's a CFA, and he has a YouTube channel. I think he has a podcast. I don't know. I was looking for a very basic entry level starter book for you to understand to get into this type of investing, and then you can figure out if you are interested or not before we dive into much meatier books, the next 2. So without further ado, we'll get into this review. This is going to be pretty brief. The book's pretty brief. So, all right. So the book is 12 chapters. Let's zoom in there. Okay. So bear with me. Okay. Yeah. Book 1 of 3. This book was published. I tried to find books that are like relevant to now, like published within the last like 10 years. I tried not to pull books that were like 20, 30 years old. Like a lot of the classics you hear about are it's tough for a book to stay relevant for long periods of time. Like One Up on Wall Street is I think what makes it such a legendary book, like I talked about before, is that it's still relevant what Peter Lynch talked about. Not all of it, but a lot of what he talked about in that book. It's like 40 years old. It's still relevant today. That's why that is such a classic book. So we'll get these dividend books. I wanted to be more recent. So this was published in 2015. I think he did a rewrite maybe a few years later, a second edition. A lot of these books, they'll do, every 5 years, they'll do a touch up where they'll change some of the references and some of the charts for new data, which is good that they do that. So it's 12 chapters. So here's all the chapters. So you can see them all. I'm not talking about every chapter. All right. I was just going to highlight a few things I thought were interesting. And this is not like a total summary. It's like a review summary of my thoughts on in this book. So this is going to cover the basic nuts and bolts of what dividend growth investing is, like just in general. This book will take you, well, I don't know how fast you read, but it's like less than 2 hours you could read this book. It's like 140 pages. It's not even like full text. It's like bigger text to fill up the space. But he wrote it intentionally to be this way. This is just like, hey, you're brand new. This is, if you want to get into this style of investing, here's what you need to know, basics of it. And then, like I said, you can decide if this is for you. Do you want to be a boglehead? Are you going to try and be some sort of growth investor? I don't know, a freaking biotech investor or a micro cap penny stock chaser? Please don't do that. But so we'll see if this is for you. Now, my thinking on this has evolved over time. So I used to be very all about just individual stock picks. So I'm trying to give you my more modern take on this stuff, not how I was 10, 20 years ago. So he talks about potential flaws. So he's comparing dividend growth investing not just to like the S&P 500, which we'll get in later, but he's comparing it to other styles of investing that like a financial advisor would put you in, which is a better comparison to him. But in this chapter, so the potential flaws of the 4% rule for retirement. So he's doing a comparison of like, why would you do dividend growth investing over other traditional styles of investing? 4% rule would be the assumption that when you get to retirement, you take 4% out to cover your expenses per year. The market grows at 7, 9, 10% per year. So the growth of the market will cover your 4% reduction. So that's that rule. But I've talked about this before. The flaw of this is, well, what if you get to the end of the rainbow, you're retired, and then that is exactly the wrong timing and the market goes into a huge correction. So now you are selling your assets when you don't want to sell them, right? Not the ideal time. So that this is basically the crux of what he's talking about, 4% rule. Then he also talks about bonds. Okay, now you're like, okay, I want no volatility. I want risk-free returns. Let's say if you were going to be huge bond assets, bonds don't grow. The interest payments are fixed. It is what it is. It's the coupon payment. And then this is a whole nother subject beyond this to get into bonds like right now with interest rates going up. Bond ETFs have gotten just murdered, which he wouldn't have written in this book because that didn't happen yet. He was in the middle of quantitative easing during this book. So then the other one, the destruction of your portfolio by inflation. So it's just like with bonds, you're not getting growing payments, right, or annuities. So inflation's just going to eat up basically your if you have a certain amount of expenses, they'll keep getting more expensive with inflation. Eventually that'll get over your assets, and then you're going to have to start selling assets because you don't have enough income coming in to cover it. So that's the crux of why he's saying these are bad. I'm probably going more into it than he does in the book. It's funny, he does attack age-based investing. You can read it. Like I said, in my checklist, I suggest you either buy a total market or an SP 500, or you do a target date at 20, and then you just pick one and you go with it for at least the first like 5-10 years. His thoughts on why it's a bad choice is mostly because of fees, is what in the book he's attacking age-based investing as a methodology because of the fees. So remember 2015, so it's a little outdated. There are target date funds that are, I found, 0.12 expense ratio. So it's a totally fine, justified investment thesis these days to do the target date funds. So that's different. It's not his fault. It's just, things have changed. Okay. So this is kind of his big sales pitch, I guess, as a CFA. Remember, this guy's a CFA, so he builds, retirement strategies for people. Ideally, if that's what he's doing as a CFA. So the perfect retirement strategy, this is what he says: grow wealth long term. I mean, yeah, of course. Why else are you investing? Minimize volatility. I don't know if minimizing volatility is, so he crux it as uh, minimizing volatility so you sleep well at night. I don't know if that's really, is that part of it. It's nice if that is part of your portfolio, but I don't think you need to seek out low volatility investments per se. Over long periods of time, does it really matter so much? I don't agree with that part, but he wrote what he wrote. Generate reliable income. So this is dividend growth investing, right? So the idea is a reliable, growing stream of income that you're developing and you're building over your life. So yes. Income grows as fast as your expenses. So obviously, that's the part about dividend growth invest, not just highest yield. You want growing dividends because your expenses will grow over time. You can go look at CPI data. Everything's getting more expensive, especially more recently, which he didn't even see that, the freaking 9% inflation we just went through. Easy to understand and follow. I definitely agree. You should be investing in things you understand. That's why part of the reason I don't like JEPI, because you don't understand what you're investing in, or any of these covered call crazy strategies that are coming out now. If you can't easily understand, you shouldn't buy it. And so this is good advice. I 100% agree with that. Chapter 5, he goes into a specific example on he takes a Coca-Cola and he does some charting to show you, if you reinvest the dividend and the growing dividend, how much money you're going to get after 20 years, which is fine. I mean, math is math. So I think the only thing I would tell him is, like, I don't know if he's a Warren Buffett guy. I don't really follow his YouTube channel, but if you're going to talk about dividend growth investing, of all the stocks to pick to use as an example, why are you picking a Warren Buffett stock? I don't understand that. Why not pick something that people aren't totally aware of as a better example to highlight this style of investing? Warren Buffett is not a dividend growth investor. So I think you're going to confuse people by picking Coca-Cola for an example of a good investment. So that's my crux. I mean, I think better examples for the modern day. Okay, 2015, I understand. He could have picked, but honestly, in 2015, he could have picked Abbott Laboratories. I think would have been a better example of this style of investing, or Caterpillar. So that's my opinion. Like Abbott Laboratories, we can go look at their financials. Growing. Look at the revenue. Revenue's growing over time. dividends. We can look, payout ratio is great. The dividend growth rate averages 12% per year the last 5 years. If we go look at the history, you can see that appreciating dividend over long periods of time. And then here's like in the history, this is just a phenomenal company. I mean, the dividend is doubled from 2014. It was 22 cents a quarter, and now we're up to 51 cents, over 100% growth. I think he could have picked. There's better examples. I think like if you're like 20 years old, you're really young. This style of investing, you should be thinking of companies like this. This company has such a bright future, I think, in semis and AI chip technology because they provide machinery for the industry. So this is the type of stuff we got to get beyond the Pepsis and McDonald's and Coca-Colas in your thought process with companies. And I know the yield's low. Yeah, I know. But that's not what this is about. It's not about this. Okay, it's about that, and it's about this, and it's about the fact that they have growing revenue, growing income, great future ahead of them in a growing industry. So the thinking, he's on that way though with this book, which is why I picked it, because he's not just focused on the current income; it's about the future. So I agree with that. He more talks about reinvested dividends than the growth of the dividend, which kind of bugged me because the reason this is different than just picking a high yield fund, because if you were just interested in reinvested dividends, and just go pick the highest yield fund you can find, right? Because then you'll get more reinvestment. That's not what this is about. So growing, appreciating dividends along with companies that you feel have good, projected future growth, you think, which is the hard part. Chapter 7. He talks about if you can beat the market with this type of investing. And of course he says yes, because if he said no, I don't think he'd sell any books. I mean, I think if you're going to compare dividend growth investing to like QQQ or SP 500 directly, I don't know. It's kind of a weird way. Like I would compare it more to like a portfolio, right? A dividend growth strategy would be like your whole portfolio. So you should compare it to somebody that's like 60-40. So someone that went like total US market, 60%, 40% bond market. That is, I think, a more realistic comparison of somebody's portfolio to portfolio, not a investment strategy compared to a benchmark index. Or you could compare it to some other strategies. So, of course it can win, or it could not. If the U.S. market goes sideways or starts going down, this strategy will do great because growth will suffer, but this strategy will perform better in that type of market. So who knows? You have up years and down years. So last year was a great year for me. 2022, the market was down 20%. I wasn't down 20%. So it is what it is. So he talks about long versus short-term focus. He's really harping on mutual funds. I know it's 2015. It's like Mo with everything money. I don't understand this harping on mutual funds and their high fees. So maybe that was an issue in 2015. I don't honestly remember. I was individual stocks 100%, except for my retirement account. So apparently high fee mutual funds is a big problem back in 10 years ago. Because I'm like, I can find you really low cost mutual funds now that would work fine for you. Same cost as ETFs. So that's outdated thinking, which I don't know why. But okay, this chapter, I'm not talking about all the topics. So what I highlighted, he talks about, are dividends right for you? What's good about this strategy, which I've talked about before, is your dividends are growing faster than inflation. So you're going to have growing income with this strategy. If you want to go look at someone that's doing this right now, Gen X Dividend Investor, his YouTube channel, which I have referenced, he's basically a dividend growth investor with most of his investments. And I think he was at $100,000 dividend income. Now he's up to like 120 within a few years. So that is, he takes all his dividends out and lives on them because he's retired. So that is just pure dividend growth. That's a pretty good, growth in his dividends. He's not reinvesting them anymore. So that's this in action, right? And you can do this your whole life, or you could be a boglehead and then transition to this when you retire. I mean, I don't know you. It's your decision. So I like how he did cover there is a page. I wouldn't even call it a chapter. It's a page about emotional anchoring. I call it emotional armchair. But the good thing about this strategy is dividend growth. It helps avoid panic. It's just, why does retail underperform? I mean, it's the biggest thing you have to understand, and we all think it's not us, but it's mostly a lot of us out there. The stats show it. But you panic when things go bad. When things go good in the markets, you buy too much, and then when things go down, you don't buy. You think you're going to buy the dip, or you think you're going to be greedy when people are fearful, but you're not. Most of you are not. Most of you panic or you get worried. Last October was an amazing time to buy stocks, and a lot of you probably didn't buy them because you thought the US dollar was going to go to zero. So, be realistic about who you are, and the statistics show most of you watching this are the type that will do that. You will panic. You will think about selling everything. You won't buy the dip. So this type of strategy would benefit you because when your share, the stocks go down, the yield goes up. You're getting a better yield if the price goes down. So I know a lot of dividend investors that are excited right now for the uncertainty because they see opportunities with things like Hershey going down. So in bad times, this strategy will keep you engaged in the markets, and better than other strategies. Okay, so I talk about it more neat, but he covers some Dividend Kings. Like I said, I don't think you should be so focused on like long-term Dividend Kings in your portfolio. I don't think you should have like a bunch of, Procter and Gamble type companies. Have a few is fine, but like if you have too many of those, they are very mature companies. It's debatable how much growth is ahead of them. I would say if you're younger than me, you should be looking for the next dividend aristocrats, or kings, which there's slightly different definitions. You should be looking for the next. What are the dividend aristocrats 20 years from now that aren't yet? That's what you need to be focused on. Like KLA could be one. Could they look like they're building a track record to be one of those? Or Granger is doing great with their dividend and great business model. So you should be looking for the next ones, not the ones right now. All right. Well, this is taking longer than I thought it would. So he talked about starting a dividend portfolio. So this must be archaic from his time because like I used to pay like $8.99 for commissions, one of my brokerages, and then it dropped to like $5.99. Then it was the free. If you're younger, like the $0 commission has only been around literally for like a few years now. This is very new for investing. Before then, you were paying $5, $15, $20 if you go back far enough every time you made a transaction. So that's a consideration in the book that doesn't exist anymore. He said like if you're going to buy individual stocks, 10 to 30. Okay. He does say though, I'm impressed that because he's kind of an individual stock picking guy, I would say overall, but start with ETFs if you have under 10,000, especially with dividends. And I agree. And I didn't understand ETFs you could buy outside of a 401k until more recent, thinking from me. There's some great dividend ETFs for you to start out. You don't have to start out buying Verizon and AT&T and Exxon Mobil and what other freaking crap people buy to start. And they just buy these 8%, boring Altria. It's like, you don't need to start with that. There's 5 or 6 really good growth dividend ETFs that I could recommend. That's all you need if you want to invest this way. And you could your whole life could just do that, or you could start out that way, and then once you get over 10,000, you could maybe pick a few individual research companies to add to it. So payout. He talked about payout ratio is important. Yes, I wasn't talking about free cash flow payout rate or free cash flow ratios. That's a more advanced topic. Should you hire a financial advisor? I mean, there's so much involved in that. He is a CFA, so he has some actually quite a bit of opinions on this. If you need somebody, can you do this? Can you do what we're talking about here? Yeah, you can invest on your own. Are you the type of person that can do this and not panic? Are you indecisive? Do you change your mind all the time? Are you afraid on the next correction of the market you're going to sell everything and overthink it? You might want a financial advisor that can talk you off the ledge. So I don't know. You're going to pay them a fee. So, that service ain't free. They get a fee out of it. And they're going to recommend you investments that, they're told to, recommend you, probably like the sales pitch, right? So it's a double-edged sword. They might keep you from panicking and selling everything at the worst time of your life, like after the Great Recession. I covered in a video, like people sold their whole portfolios and never came back in the market. So I bet they would have rather paid a financial advisor a fee that would have told them not to do that. They would have been better off in life. So I don't know. Only you would know the answer to this. My parents use Edward Jones, so I don't do investing for them. I really don't want to. So, do you need Edward Jones? I don't know. It's a legitimate question, but you're not going to be able to probably do dividend growth investing through a financial advisor. That's not something they teach them. They're going to load you with some sort of 60-40 or a whole bunch of mutual fund ETFs all over the place, like REIT, bond market, high, small cap. So they're going to give you stuff like that. So, and then he gives you some questions you could ask if you did want to talk to a financial advisor. So here is his channel. He's not under my recommended channels list. If you look at my channels list, he's a fine YouTuber. I don't really follow him all the time. But he gives a lot of good beginner data. He has had times where I think he's misstated things. I've seen comments where people correct him sometimes on his math. But this is a good starting point for anybody that would be interested in this style. And it's not just individual stocks. I used to think you only could buy individual stocks, this style of investing. I've kind of matured on the subject. You can definitely do this with ETFs. You don't ever have to buy an individual stock to invest this way. And there's different ways to do this. All I would ask you, what works for you long term? What can you stick with? Like right now, it's pretty uncertain times. Could you stick with this strategy right now? When some people think we're going into recession next year, could you keep buying through dips in the market? So, and just one point, like just as a comparison, like here's different comparisons, right? So I did asset. So number one is like all dividend growth, right? Let's just say you went like, it's a play on 60-40. So I did like 10,000 start, 500 contributed quarterly. And I always do my comparisons from Great Recession to modern day. It's the easiest way to do a comparison. So here's a total dividend growth style portfolio, 60-40. Here is a 60-40 traditional, which is like say VU and then a total bond. And then here is a variation that works great. Total US combined with a dividend fund also. So this is like a core satellite style thinking, right? So if we look here, the only one that appreciably went bad, the 60-40, 60 equity, 40% bond, did terribly compared to the other two. The other two are like variations of a core satellite dividend growth style. So this does work if you do the right, this is, if you, of course, if you say compare this style straight up at VU, probably not. Or QQQ, well, okay, that's, depends on what you want to compare it to say if it's going to beat the market or not. So yeah, that is this book. So you probably, in the time you watch this video, you could almost finish reading it. Honestly, it's very light reading. So the next one, I don't know how this one gets pretty meaty, and then the one after it, I could spend an hour. Like there's so much to talk about. The third one, where they actually have modeling. I'll show you the model because I built the model. The third book has actually, it's not a valuation model. It's a projected growth model of the stock and the appreciating dividend, it's kind of interesting because it's not telling you what price to buy it. It's just telling you what the expectation of return could be if you bought it at that price. So I've never seen a model like that. And I picked that one up a few years ago, which I think it's interesting because it's a different line of thinking when you're valuing the appreciation of the investment. You're not valuing the stock per se. These will be the three. I know people can say, "Oh, what about this book? This book?" Like I've looked at other books. A lot of the other books I look at, it's like 250 pages, and honestly, about 20 pages are interesting, and the rest of it's just filler to someone like me. So a lot of books are honestly not worth much to read. I could take 10 dividend books and tell you to read like 20 pages of each one, and that would be it. Like, but most of them, it's just like, it's just rough. It's just so much. Like a lot of these dividend books, if it's 300 pages, like literally get to like the first 100 pages, just skip it. And I would just start reading it like 101 page, like page 101. But this is a good way to start. If you want to check his videos out, I go for it. I don't watch too much of his videos, but I thought it was a great beginner book for this line of thinking. So with that said, this is way longer than I thought it would be, but thanks for watching. I will have the next one is Moat. I'm really excited about this one. We're going to cover Moat, the ETF, and then I'd like to talk about moats in general with investing, and is there any research to back up the moatiness of a company? Should you be looking for that? So that'll be a fun one for me. I'm excited. And then after that, I don't know. At some point, I should do SCHD. That's what everyone cares about, I suppose. So with that said, thank you for listening, and I will see you later. All right, bye.
Thank you for your cooperation. Good night.
I'll buy that!